Today is Saturday, August 1st. This is my weekly stock market update. I'll be going over what happened this week and a few key things to look out for heading into next week. So the broad market, the S&P 500 regained control of its 50-day moving average, which is very good, but the tech side of the market, the Qs, is still being sold off. The RSP, which is the equal weighted S&P 500, is still trending nicely above its 50 and 21-day moving averages, which is really good for the broad market. But I do think that tech needs to regain control, or we need to see a new sector pop out and start leading the market. CIBR, the cybersecurity stocks, are showing relative strength. They're holding up the best, in my opinion. A few stocks from that sector are CrowdStrike, Palo Alto, and Fortinet. Stocks and DRAM, two of the key sectors that we were looking at last week and the week before, they are still in trouble and they hit resistance at their declining 21-day EMAs. Bottoms are ugly. I do think maybe we have bottomed, maybe we have not, but I do know that bottoms are ugly and it's never going to be such a clear cut bounce off the bottom, and it's not going to be easy. So I am focusing on the 21-day exponential moving averages, as it seems to be a good indication for these two sectors of the trend. Obviously, being above the 21, they are trending higher, and below the 21, they are trending lower, especially if the moving average is increasing or declining. It's very important. And obviously, the 50-day is still very important, but I think the 21-day is a bit more important, and we need to get above the 21-day before we get above the 50-day. A few stocks on the RS new high list. I would like to say some stocks are making new highs, but the market environment may not be great for these new buys. ARXS, Datadog, and PAX are three of the stocks that I would like to look at later when I pull up the charts. And we also had a lot of news this week. Everyone on the streets talking about Leopold and his blow up and his margin calls. Essentially, he was 4 times levered in a lot of the AI heat names and the AI trade. So he was margin called and his positions were bought up by Citadel. A few stocks that I'll look at that he owned is CoreWeave and NBIS. Few energy stocks, BE, IREN, CLSK, and Riot, and then a few memory stocks were SK Hynix, Micron, SanDisk, and the SMH, which is kind of like the stocks. It's just a chip sector. Kevin Warsh also kept rates where they were. I actually do like Kevin Warsh and I do like his speeches, but the market ended up selling off after the speech into the end of the day, which is not what we wanted to see, but sometimes reactions take days. So maybe this sell-off wasn't entirely for Warsh's speech. Maybe it was just some market mechanics unwinding. The Iran war, there is still a lot of uncertainty going on, and the 30-year Treasury yield actually spiked up to 5.2%, which is the highest level since 2007. So that could be a potential warning or a red flag for some investors. Next, we had hyperscaler earnings reports. I believe the market is still uncertain whether all this AI CapEx spending is going to be worth it. Last week, Google reported and they sold off. They said that they were increasing their CapEx and they reported negative cash flow for the first time since its IPO in 2004. I know other hyperscalers are also posting negative free cash flow, which can be bad for in the minds or from the views of some investors. You know, these hyperscalers were massive cash cows and now they're actually reporting negative free cash flow. So this is definitely a interesting thing to look at in the market, and we're just going to have to see how it plays out. But it is very interesting to me that, you know, these huge companies are now posting negative free cash flow, and it shows how much they're spending on AI trade, and I guess we're going to find out in the future if it's all going to be worth it. So Amazon and Microsoft also crushed earnings and they are looking well. So Now I'll move on to the charts. So now looking at the charts, as you can see, the S&P 500 did close back above its 50-day moving average, which is really good. But when we look at the Qs, we did not. We couldn't even close above this declining 21-day moving average. This is very similar look to the SOX, the semiconductor index, which once again rallied up to the 21-day and declined it and closed at the low of the day. DRAM did this as well. Why am I looking at these? These are important sectors of the market, and I'm trying to just see if they're going to regain leadership, but currently they do not look that great. I'm going to pull up Google. Like I said, they gapped down on earnings off that negative free cash flow, and since then they have rebounded, rallied up to a declining 55-day moving average, and sort of rejected it. Apple down big on earnings. Amazon crushed, up big. Tesla, Nvidia's holding this 200-day moving average, which is good. Meta, not great earnings reaction, and Microsoft rallied nicely off of its earnings reaction. The next chart I wanted to look at is CIBR, which is the cybersecurity stocks. As you can tell, they are trending nicely above its 55, also above its 9 EMA and its 21, or this is actually a 22-day EMA. So this sector here is showing relative strength and it's outperforming the rest of the market. I'll take a look at CrowdStrike. Looks very similar. Fortinet, which gapped up on earnings pretty big and then sold off, but then the next day it rallied back. So Fortinet looking good as well. And lastly, Palo Alto looks very similar to CrowdStrike and just the overall CIBR. Next, I'll take a look at a couple of stocks on the new high list. ARXS. This chart looks very good, but like I said, might not be a time to make new buys, but this is I'll just pull it up in Market Surge. As you can see, it is in the aerospace defense group and it's breaking out. So if we were in a better market, maybe I would have tried to play, especially on Friday. Maybe I would have tried to put a buy in there as it gapped above or rallied above this base, and this is a very nice breakout. This is a new IPO, but this stock does look very good. The next stock I wanted to look at is Datadog. Once again, 98 RS, it's above its 50, it's above its 21. This looks good. This is a nice little, I guess you could sort of say this is a cup with handle-ish looking chart pattern, but if we were to break out, maybe you could put a stop below Friday's low and try to play the breakout, but once again, this market environment isn't the best. And I wanted to look at PACS as well, 97 RS, but I really wanted to look at this chart back here. I remember I was trading it. This chart looked amazing. This breakout looked amazing, and I was actually in this stock. It was relatively strong. It was a great leader in the stock market, and then all of a sudden it had this huge day where it just sold off in the middle of the day and it was down 27%. And this is why it is very important to cut your losses, because while this stock was down 27% this day, I actually sold it around 10%. I think it was as it was crossing below this 50-day moving average. And as you can see, this was the beginning of the destruction. So the next day it was down another 4%, and then the next day it was down another 38%. So this is why it is very important to cut your losses small and to pay attention to the stocks that you are in. As far as any actionable trades to the long side, I would look for relative strength. I would look for stocks that are holding up better than its sector, better than the general market, maybe stocks that are making new highs. And I would watch the general market sectors like the Qs, I would watch the SOX, I would watch DRAM. If you want to play any of those names within the sector, I would wait for the sector to show strength, get above these moving averages, and I would play the stocks that are performing the best relative to its sector or the general market. So I don't know if we bottomed. Maybe we did, maybe we didn't. All I can say is I'm going to be looking for relative strength, and I'm going to be looking for the market to get above these key moving averages. I have been focusing on these ETFs like SOX and DRAM because when you play an ETF like this, you don't have to really worry about the individual stock risk. So let's just say you're bullish on the memory trade and you don't know what to pick. You don't know whether to go with SanDisk, Micron, SK Hynix, Seagate, Western Digital. You don't know which one to pick. You can just pick the bundle and you can just go with the entire sector. So yes, it does take away some of the individual stock risk, but at the same time, there could be some underperforming stocks in here, and maybe you will be better off if you pick the right stock. But for me, it has been easier to just trade the SOX. Maybe if I want a little bit more juice, you can trade the SOXL, which is the 3X SOX. And I have found that it has been easier to trade these ETFs as a whole, or trade the entire bundle, rather than to try to pick the individual stocks that are gonna outperform. Yes, you can use relative strength and you can track these individual stocks, and I'm sure if you do pick the right one, you will have outperformance relative to the bundle. But I think it is a lot easier to just go with a broad ETF, especially when the SOX and DRAM have been moving as much as they have been. So that's why I focus on these ETFs a lot, especially in this specific market environment. And the last thing I wanted to show is just how I was saying earlier, how DRAM and SOX tend to respect the 21-day EMA more than the other moving averages. So as you can tell, if this is hindsight, but if you were using the 21-day as a demarcation line, the second you get a close below the 21-day, you would have been out. And as you can see, you would have been shaken out here with this close below the 22. But here it would have saved you, a lot of downside. So that is why I'm focusing on the 21 for these two ETFs specifically. As you can see, the Qs, they don't respect it as much, so it is less important on, I guess, stocks or ETFs that don't respect it as much. But when you do see a chart that works like this one and like DRAM, you want to pay attention to these demarcation lines. I would appreciate if you dropped a like on the video if you did like the video, and maybe click subscribe if you want to see more videos like this. I do plan to release a weekly stock market update every week, and maybe I'll start doing some daily stock market videos on key important days. Maybe something happens during the day that I really want to cover. Maybe I'll release a video that day. But that is it.